that's really the only difference between a market maker. A lot of people have trouble making the optimal trade entry work. 90% of traders, whether it's stock traders, crypto traders, or forex traders, are facing the same issue. And that is they're jumping from strategy to strategy in hopes of finding the one that's finally gonna make them profitable. Last year, I made well over 6 figures publicly trading the system that I'm about to teach you. So after watching this video, you know that you are equipped with a profitable system. Now, all you have to do is stay loyal to this system and refine it to your liking. Because as I always say, a profitable system is not found, it is not copied, it is built. So without further ado, the first thing that we'll talk about is a concept that we call the market maker sell model. Now, the reason why this is very important is because this is the concept that will allow you to predict the direction of the market. No trading system is going to work if you can't predict the market or at least tell where the market is most likely going to go next. So what we're looking at here is a picture perfect market maker sell model, and the curve that you're seeing me draw now is what we call the buy side curve of a market maker sell model. Now, this part of the curve here is essentially made to engineer liquidity. So all these lows here is engineered liquidity. And if you're confused as to what liquidity means, it's essentially just a fancier word for a lot of stop orders. So whenever I refer to liquidity, all I really mean is that there is a lot of orders resting below the lows that I've just annotated. The reason for that is because there are thousands of traders that long the market off of this consolidation as well as this one. And what all of these traders are taught is to place their stop at the lows. And so we can, with reason, expect a bunch of stop orders to be sitting right below these lows. Now, what we are interested in here, however, is the sell side curve, okay? Because we are looking for shorts. So what we're seeing me draw out now is what we call the sell side curve. And this right here is the curve where we will be looking for our entry. So the consolidations that you're seeing actually have a name. Now, the first one here is called the first stage distribution. And the second consolidation is, funny enough, called the second stage distribution. Markets will move exactly like this. They will displace with volume, then they will come to a point of balance and you'll see a consolidation followed by imbalance, followed by balance, followed by imbalance. Boom, boom, boom. That is how a market moves. And that is exactly what we're going to take advantage of in this strategy, because what we'll do is look for our entry in the second stage distribution. Now, the reason why it's important that we look for our entry in the second stage distribution is because if I now start looking for my entry in the first stage distribution here, well, then I am not as confident that it is a market maker sell model. The reason for that is because if I look for my entry within this consolidation, I have already seen the market repeat the pattern twice. Now, the pattern I'm talking about is, of course, consolidation, displacement, consolidation, displacement. Now again, consolidation, displacement. And so we have a lot more reason to believe that this consolidation is going to lead to a displacement down lower because we've already seen it happen twice already. And so that is exactly why I always recommend that you look for your entry in the second stage distribution, because it just makes the overall trade a lot higher probability. Now, does this mean that you cannot look for your entry in the first stage distribution? Absolutely not. If you are very confident that this is going to be a market maker sell model, you can of course look for an early entry in the first stage distribution. All I'm saying is, if you decide to enter in the first stage distribution, you should probably reconsider your risk approach. So whenever I trade from the first stage distribution, which I will do at times, I will do it with significantly lowered risk. Now, this is of course not what you guys are looking for. You are looking for the actual entry model. So let me get right into it. There's a few things that I've noticed throughout the years of me trading market maker sell models and market maker buy models. And one of them is whenever we see the displacement happen after a consolidation, there's a very good chance that the market will create fair value gaps or imbalances within that displacement leg. Now, we will typically get one or two, and if there is two imbalances in a market maker sell model, well, then there's a very, very good chance that the top one of the two is going to hold, meaning the first one that we create is going to fail and the second one is going to hold. So the same thing goes for the first stage distribution. If we get two imbalances here, you can expect the top one to hold and not the bottom one. I've found that there's about an 80% chance that the top one is the imbalance that's going to hold when we have two imbalances within a market maker sell model. Now, of course, when we talk about market maker buy models, all you do is flip the script and you'll have a market maker buy model. So what I'm looking to do here is not just short the imbalance that you're looking at here. I want a lot more confluence, and I get that through a tool that we call the optimal trade entry. Because what we're essentially looking to do here is try and predict the top of the pullback that's happening within the market maker sell model. And the easiest tool that you can use to predict tops and bottoms of pullbacks within trending markets is simply going to be the optimal trade entry. If you're wondering what exchange I use to place all of these trades, it is called toobit. Now, I've tried out the majority of crypto exchanges, and toobit is simply one of my favorites. Their support team is great. They have a welcome bonus. Actually, I can show you right now on the screen. If I come up here, click use bonus, you can see that I got a free 10 USDT from simply joining. So they have great bonuses. Their interface is really simple to use, and their support is great. So if you don't have an exchange yet, or you're looking to change, I would highly recommend that you check out toobit down below. So if you don't have the settings for this yet, I will pull it up, and there you go. You can take a second to copy that. So the idea here is that the second stage goes to the optimal trade entry, and it is very important to understand that you always enter from the 0.618. So this is actually a semi-mechanical strategy, meaning your entry is always going to be the same and your stop loss is always going to be the same. Now, the reason for that is because there's always reason for us to believe that the pullback is going to end within the first zone of the optimal trade entry, and there's always going to be a reason for my stop loss being placed at the 1 zone. Now, the reason for the stop loss is if this is truly a market maker sell model and we are going lower from the second stage distribution, well, then we are not going to run the highs of the first stage distribution. So ideally, we enter into the second stage and our stop loss always goes above the highs in the first stage distribution. So having the stop loss at the highs of the first stage distribution is very important. I see too many traders that have absolutely no reason behind their stop loss, and it is a downfall for a lot of these traders. Now, our take profit, you can either run at the internal liquidity, which is these ones here, or you can hold all the way until the market maker sell model finish. So this right here is exactly what the trade would look like. My entry would be at the first optimal trade entry zone. My stop loss goes to the 1 or the highs of the first stage distribution, and my take profit can either go to the internal range liquidity or to the external range liquidity, aka the market maker sell model end. Now, of course, it's important that you understand that it's not always going to look this clean. This is obviously an example that I have drawn out, so it looks very clean and easy to spot. So what I'm going to do is show you a few examples of trades that I have personally taken executing this very strategy so that you can see it's not always going to look picture perfect. Now, again, I'm quickly going to run over what we're looking for in this strategy. We are looking for a buy-side curve to be created that essentially engineers liquidity here. Now, it doesn't have to have these consolidations here because another form of liquidity is actually imbalances. So let's say instead of doing this the traditional way, it just displays completely to the upside, and then we saw the consolidations over here. That is completely fine because that means that this entire leg is filled with inefficiencies that the market also wants to fill. But again, 90% of the time, you are going to get the consolidations that we're looking at right here, and that is going to engineer sell-side liquidity for you. So we then wait for the reversal, which we call the smart money reversal, and that often takes place at a higher time frame point of interest. So that could be a higher time frame imbalance, higher time frame order block, higher time frame breaker block. Some type of higher time frame PDA rate is very likely going to be what starts the market maker sell model. And again, that is what we call the smart money reversal. We then wait for the first displacement leg, then we wait for the first consolidation, then we wait for the second displacement leg, and in the third consolidation, we look for our entry at the 0.618 of the optimal trade entry. Now again, we draw it from the high of the first stage distribution and down to the low of the second stage distribution. We then take our entry off of the first zone. Our stop always goes to the high of the first stage distribution, and then our take profit can either be taken at internal range liquidity or external range liquidity. So right here, we are looking at a perfect example of this system playing out. This was a trade that I took myself some time ago, and as you can see, this right here is the buy side curve and this right here is the sell side curve. Now notice how we've engineered sell side liquidity here, we've engineered it here and here. That is exactly what we want to see. So at this moment in time, we have a bunch of liquidity that's been left unfilled. We've also seen a first stage distribution right here, and we are now looking to capitalize off of the optimal trade entry, drawing it from the high of the first stage down to the low of the second stage, We are going to short the 0.618, and we're going to take our take profit at either this internal low or the external one that we're seeing down here. So that is just a perfect example of this strategy actually playing out. What you really want to look for, if you want to simplify it for yourself, is these V-shaped patterns, because again, if I draw it like this, it really just looks like a hat or a V shape, and that is exactly what we want to look for. Now, within that V shape, all you look for is one consolidation, then another consolidation, and of course, you look to short the second consolidation from the 0.618 optimal trade entry. That right there is exactly how you combine a market maker sell model with an already existing strategy, such as the optimal trade entry. A lot of people have trouble making the optimal trade entry work because they don't know how to combine it or how to actually use it. This right here teaches you exactly how to use the optimal trade entry to your advantage, because I personally believe that the optimal trade entry is the single greatest Fibonacci extension there is. So again, just a perfect example of this very system playing out. So we're looking at the last example of today, and this was also a trade that I took some time ago. Now, as you might be able to tell, this is not as clean as the other one, which is also important to show because they are not always going to appear as clean as I just showed you. So what we really want to identify here is, first of all, this is a market maker buy model and not a market maker sell model. So again, it's still that V-shaped pattern that I was just talking about, but this time around, we've engineered buy-side liquidity instead of sell-side liquidity. And that's really the only difference between a market maker sell model and a market maker buy model. It is just flipped. So our job now is to identify the first consolidation, which I would argue is this entire box that you are seeing right here. And then the second one is the one that I'm drawing now. What we then do is draw our Fibonacci extension tool from the most recent swing low of the first stage distribution to the most recent swing high of the second stage. And of course, we take our entry from the 0.618 level and our take profit at either internal highs or external highs up here. Now, you might be a little bit confused because if I draw out the first stage distribution as you're seeing right here, you can see that there's 1, 2, and 3 lows within that first stage distribution. So how do we know which low to draw our Fibonacci extension tool from? Well, what I always say is you want to draw it from the most recent swing low. And so when we take a look at the first stage distribution, which is the one that you're seeing right here, this low right here is the latest one. So we are not looking to draw our fib from that low or this low, because this right here is the newest low of the first stage distribution. So again, this was just another nice example of this strategy actually playing out. I've personally traded this very system in the stock market, commodities, forex, futures, and crypto. So I can guarantee you that this works, and all you have to do is put in the work and don't change your system like you change your underwear.